Well, good evening, good evening, good evening once again, welcome. I am David Etienne, owner, CEO of Etienne Business Solutions. We're an accounting firm, and also, in addition to our physical location, also want to encourage you to check our YouTube channel, Etienne's Place. Etienne's Place, where we have a number of videos posted, and of course our live Tuesday streams are also there, in addition to quite a number of other videos covering a wide spectrum of business topics. So once again, welcome, happy that you can join me, and so we'll jump right into the good stuff. And as usual, I always say that subscribe, like, and so once you subscribe, all new content will be brought to your attention the moment that they're available. So without further ado, let's jump into this evening's videocast. There's been a lot of talk over the years about using home for business purposes. Using home for business purposes. As a matter of fact, prior to about, let's say, 2-3 years ago, it was allowed that any individual who uses a space in home for business reasons were permitted to make a home office deduction. And then came about a modification to that rule, where the understanding is if you are an employee, meaning that you are a staff member at an organization, you're an employee, and if you, as an employee, utilize a part of your home for office operations, you are no longer allowed to take a home office deduction. Home office deductions now are reserved for independent contractors. Okay? So you operate a business, you are not renting out on the mall, but you use a section of your home, and so you have a home office deduction. In the past, if you're an employee to an organization, and for whatever reason you use a part of your home to conduct office work, you are allowed some deduction. That is no longer the case. I suppose that if you are on the job, you're an employee, and you have to take work home and utilize a part of your home, then the understanding would have to be with your employer that you will have to send in what you call an expense statement so that you can be reimbursed for whatever costs you incurred, right? But all said and done, the home office deduction is something that most individuals are aware of, where you do your thing, the rules that govern, okay? You have to have a designated area, not used in addition to being a sitting room or an exercise room or a baby room that you use a part of for a home office. It must be dedicated space. As a matter of fact, you're advised to really equip that space as a normal office. Your printer, your computers, your filing cabinet, you name it. It's a real office, just that it exists in the home. Okay? And then you have a formula that is used, which happens to be the percentage or the square foot used for office space in relation to the total square footage of the house or the home. That gives you the ratio, and then you will apply that ratio or that percentage to the various home expenses, maintenance, repairs, utilities, etc., etc. Cool. So that has been home office deduction. There's I don't know if I should call it a little known rule, but I think it is less known compared to the general home office deductions. And this is what we call the Agusta rule. The Agusta rule. And interestingly enough, the name came about because it actually originated in Agusta, Georgia. I found that very interesting. It originated in Augusta, Georgia. How did it come about? The residents of Augusta, Georgia, okay, were in the custom of renting their homes during a certain time to facilitate individuals visiting, because that area, as you know, is where they have the Masters Golf Tournament each year. So with that event happening in Augusta, Georgia, it was a good market for homeowners to prepare their houses, their homes, and make them available to the visitors that came into town for that tournament. And as a result of that, that rule came about. And basically what the rule is saying is that, yes, you're renting your home. As a result of renting your home, you're receiving rental income, which under normal circumstances would be taxable income. That's income to you, the homeowner. But the Agusta rule states that if you rent your home for less than 14 days, okay, so you just keep it within the 14 days limit, then any rental income received will be tax-free money. I repeat, if you rent your home for less than 14 days, then the income received from renting that home will be tax-free income. Naturally, if you go over that period into longer periods, then it is seen now as maybe entering a normal rental arrangement, and so the normal tax implications will hit. But the Agusta rule is saying, and I can understand, because I would imagine those folks who were visiting Augusta just came for the tournament, and so yes, a 2-week period maybe was adequate, for the visitors to come, attend the tournament, and then head back home. So that 14-day, that 2-week period was the window, allowed the Augusta residents to let their homes be available to visitors, collect rent or collect some income, which is really rent, but avoid paying taxes there. Okay? So it started there, but by now it is something that is applicable throughout the US. Okay? It is generally applicable that if you rent home, that is a treatment that is allowed once you're within that 14-day limit. So that is a big benefit to those who are in the position to rent their homes. However, the Agusta rule is there, but in addition to that, we have what is known as Section 280A deduction. Section 280A. Okay? That's Section 280A deduction. And what this section does is to provide an added benefit. So it is saying if you, in addition to owning your home, you operate a business, whatever type of business it is, doesn't matter much. You operate a business. So from time to time, your business would need to maybe have a workshop somewhere, have a staff function, have some event related to the operating of your business. Naturally, what you would do is to go and seek places to rent. Naturally, a hotel, meeting room, some area where they have space to let. So you would have to find somewhere to rent to hold your company event, meeting, workshop, whatever the case is. And you'd have to pay the cost, naturally. So the provision of 280A, Section 280A is saying if you're such a business person, you're allowed to rent your home to your business. The 14 days still apply. You're allowed to rent your home to your business for up to that 14-day period. And yes, on the one hand, as we said before, the money that you receive, because, and we're going to come into that detail, the company renting your home from you, so the company needs to pay you like it would pay any other provider of space. So that money coming into you is income from rental. So yes, it is tax-free based on the Agusta rule. But more than that, it is a normal expense for the business. And so just as how the business would be able to write off this rental expense had it gone to one of those hotels to have the meeting or the workshop, is the same way, having paid you to use your home, the business will have to, we'll have to deduct this as a normal rental expense, as in, as it would do had it gone out somewhere else. So what you notice, you as an individual, you receive income that is tax-free, but also because it is your business that rented the space from you, the business is able to make a deduction, a normal business expense deduction on its financial statements. So you end up getting almost like a double benefit right there. Okay? So it is really the merger, I would say, of the Agusta rule on the one hand and the Section 280A deduction on the other hand that converge to give you what I would call a real sweet spot. Real sweet spot. Income that is not taxed, and also a deduction to reduce your taxable income from the business side. Okay? Double benefit. Very, very important to note. Now, it sounds simple, and the truth is it's pretty simple. But like anything else, all provisions are susceptible to abuse. Abuse. So although we have this provision and this big benefit, the rules are very stringent to ensure that it is not being abused. Very, very, very stringent. Okay? So what you'll find is that, number one, you must be conducting a legitimate business meeting at your home. It can't be a gathering of friends or a gathering of co-workers to have a drink or to hang out and have some barbecue and we say, okay, yes, no. For the benefit to be yours under the Section 280A, it must be legitimate business meeting at your home. Okay? And again, ensure that it does not exceed the 14 days. And it is not for entertainment, just entertaining people. No, that's a no-no. Secondly, you need to document the meeting. Yep, need to document the meeting. Because think of it, if you had gone to one of those hotels and rent their meeting room, it's obvious that there would have been some agreement drawn up between you and the hotel. There would have been some paperwork going back and forth. The payment would be made. Maybe you'd have sent them an invoice. They would pay the invoice. Well, I'm sorry. They would have sent you an invoice. You would pay the invoice. So there would be some paper trail. Some paper trail. Not to mention the fact that the bank account would show, the receipts of the money. The same thing applies here. You are to ensure that you have to document that meeting. Okay? So you have to, if it's a meeting, just like you take minutes of a meeting, same way, you take your minutes of the meeting, and preferably so you can even mention somewhere that, the meeting of June 17th was convened at so-and-so location, blah, 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 just to make a connection between that meeting and your place. So you document the meeting by taking your minutes. Now, some say submit that documentation to the IRS. My thing is that when you file your tax returns, you file a good faith document. If the IRS feels that, okay, I would like to review this, I would like to audit, or like to question this deduction or that deduction, usually they will write you and say, please submit documentation to support A, B, or C. So it's not necessary for you to send this evidence of a meeting. But of course, having documented it, you need to keep it very safe because you can never tell. You may be asked to produce this documentation. So that is it. Next thing, if you would be able to go to a hotel, rent their meeting room for a day for $1,000, let's say, then ensure that you are not now saying to your company, I am renting you my home, my space for $4,000. You get where I'm going? So do not pad the thing. You're warned against that. So you have to actually find comparable numbers. You have to do your research. You cannot just say, okay, I'm renting my house to my business and I'm charging my business $3,000. It doesn't work that way. No. You have to look at what the going rate would be if you had to take this meeting with this number of persons for this duration to an independent meeting place. What is the going rate? What is the market rate? What is the market asking to rent a space for that period of time for that number of persons? That is what you would use as the gauge, as a guide as to how much you are going to charge. So it is saying that you have to find comparables by researching the local, the local market for whatever it is, venue rates. What are they charging for similar type meeting as the one that you are going to undertake? Because you really want your rental price to be reasonable and legitimate. Reasonable and legitimate. Because you can understand, if you're allowed to just throw any number into the picture, then you may be tempted to rent a 12 by 12 room for a half day meeting for $4,000. That is crazy. Then you get $4,000 tax free, and you'd also get $4,000 as a business deduction on the business side. No, it cannot work that way. I mean, the deductions and the tax exemptions are cool and they will work, but the number has to be reasonable. Best if you establish a rental agreement. And when I say a rental agreement, nothing technical or cumbersome. Just as if you had gone to this hotel, they would give you a simple, maybe a one-pager. Just an agreement, a rental agreement for the day. You agree to rent so and so for the day and all the details. You're advised that although it is your company that is renting from you, you need to have proper documentation, and so we're saying that we suggest that you establish an agreement, a simple agreement to show that it is an official arrangement between company and yourself. Okay? And as a spin-off of you having an agreement, a written agreement, then yes, we would expect that you would send an invoice, prepare an invoice and submit it to the company. Like anybody else, submit it to the company so that the company now can cut its check and pay that invoice. On the company side, the company best pay that invoice using company account. So whether you write a company check or you use your card, but still it must be that the transaction is reflected on the bank statement of the company. So from the homeowner, between homeowner and company, a legitimate agreement. From homeowner, a legitimate invoice to the company. From the company, a legitimate evidence of payment made by way of a check and reflected on the business's bank account. Okay, on the business bank account. So that is that, and then so we talk about the business being able to deduct this rental expense as a normal business expense. We also mentioned that the owner receiving the income will basically avoid paying taxes once I conform to the rule. But how do you actually treat that on your tax returns? Although it is something that you will not be paying taxes on, and this is very important. Some individuals think, okay, so I've made $2,000 for the year by renting my home for that period, And since it is tax-free money, then there's no need for me to even show it on my tax returns. Because what's the point? It's a non-taxable figure. But no, disclosure is important. Some disclosures will have tax implications, some disclosures will have zero tax implications. The fact is, once money flows in the form of income earned from a service or a product provided, that income ought to be reported. So how do you report that income and still be able to avoid it being taxed? Simple. It will be rental income. So if you treat it as a little business, then you could do a Schedule C. Doesn't matter. Schedule C is quite in order, and I hope most of us would be familiar with Schedule C. You would report that income on your Schedule C, but then you would also report that deduction on the same schedule. So you show it as income received, but because you do not want it to end up into the taxable pool, since it is non-taxable, then it would also be shown as a Section 280A deduction on the same Schedule C. So it is in at 2,000. If 2,000 was the income, it is out, and so it nets out, zeroes out, so there's no tax on that figure. There's no tax on that figure, okay? So that is on the personal side, and we have mentioned too how the company will benefit on that side. So therefore, you would find that, again, I'm using a simple $2,000 example. So if you earn $2,000 under this understanding, under this Agusta rule / Section 280A deduction provision, and let's assume that your figure was $2,000 earned. So if you notice, what's going to happen is, yes, your total income, because naturally you would have other income or income other than this rental figure. So your total income is boosted up by 2,000 more with zero tax implication. On the other hand, your business expense is boosted up by 2,000. For Schedule C preparers, you'll recall that your Schedule C is part of your individual tax returns. Okay, so it is incorporated in your individual tax returns. It is a net profit, or after you have your Schedule C income minus expenses, whatever is left as a profit or a loss, whatever, that is what rolls over onto the face of your 1040. But it goes into another schedule called a Schedule 1. But it ends up on the face of your 1040, your main tax form. Okay, so your main tax form will show really nothing to do with that 10,000, because the Schedule C would capture the 10,000 as income. The same Schedule C would remove the 2,000, I'm saying. Capture the 2,000 as income. The Schedule C would remove the $2,000 as a deduction under the Section 280A deduction rule. And so none of that would transfer onto the main 1040, hence no taxes. Good. That's about it. Several, in the past 2-3 weeks, I've had several clients coming to me asking about this section here, because they were wondering, is it the same thing as your home office deductions? Is it something that I can or I cannot do? How does it work, etc.? But remember now, this home office deduction is a totally separate thing, because if you operate a business, your home office is something you're going to be using all year round. And so the rules that apply to home office deduction will continue. Nothing. But we're saying, in addition to that, or separate and apart from that, you may find that you're in a position to rent your home to your business, and so we have this added benefit. That's about it for this. A very, very short topic, but one that, if you're in the position to benefit from it, then you should try to not overlook it. All right? So that's my bit for today. Very short, and I hope spicy, and give you something to think about and to apply if it relates to you. So this is David Etienne saying bye for now, and we'll be back here next Tuesday at 8 p.m. So again, remember, check my YouTube channel, Etienne's Place. And although I did not say it this time, but going forward, I have enabled the chat functionality in my video cast here. So going forward, if you so desire, you should be able to indicate your comments or questions, and I will certainly pay attention and respond accordingly. You will also see that at the bottom of my screen we have our seminars at myebsolutions.com email. So if you have other questions that you did not ask during the session, but something pops to mind during the week on what we discuss or anything else, you can shoot us an email with your questions, and we'll certainly address it and give you a response, in short time, short turnaround. So thank you once again, guys, for hanging with me, and this is David saying bye for now, and next week we'll touch on another interesting topic. So until then, have a wonderful rest of the week, work hard, stay faithful to the task, and God bless. Yes, Miss Ferguson, I see you. Yes, you're welcome. So guys, this is David saying bye for now. Have a wonderful week.